Well, good morning, our friends here at Christian Heritage. My name is Greg Ring, and I'm co-founder of The Giving Crowd. We are an organization that serves ministries across the country, across America, in the area of, it's sometimes called planned giving, sometimes called charitable estate planning. But the whole point here is helping people recognize opportunities that they might have to honor the Lord with everything that they've been blessed with, but do so in a tax efficient manner. So I'm going to walk through this pretty quickly, and then we'll have time for questions at the end. The way we like to start this conversation is not about the charity, but really about the friends and donors and supporters of that ministry. There are three needs that I find are consistent every time I work with a couple or a family. These three needs surface at different levels of priority. But the first one is family issues. It's my children, my grandchildren. I've been blessed with 6 grandchildren so far. We've got 3 more on the way. I was up at 7:30 this morning helping one of my grandsons pull some weeds in their yard. And that whole idea of how do we prepare the next generation is, it's our work. And every family is different. So you can have 3 kids that are doing great and 1 that is just off the rails. And so those are very, very heartfelt needs that people face. Another family need is just retirement cash flow. And this can be, I was with a couple in Huntington Beach, California, a couple days ago, and they're approaching retirement and just wanting to make sure that everything's lined up so that they can continue to give to the ministries they give to, but also just provide for their well-being so they're not living with their children or something. Tax issues is another one. There's taxes that we face when we sell a piece of land or a rental house or a warehouse or maybe a family business. There are some folks that might be watching this that are faced federal estate tax. Now, the way that is today, that's not very common because the amount that a husband and wife can pass tax-free today is over $22 million. So, but there might be some folks watching this. So all of these provide actually an opportunity to redeploy those tax dollars over to the ministries that you care about. So you have a choice. Those are many, many times they're optional taxes. You just have to take action to decide if I want the money to go to Washington or if I'd rather it go to my children and charity instead. The final thing is a desire for impact. How can my life make a difference? I was sitting with a fellow in his conference room years ago, and we were talking about these 3 needs. When I got to this one of the impact, he literally reached across the table and grabbed my arm and said, "That's what I want to talk about. I don't need any more money. My kids are set. But what I want to know is how can God use me to make a difference?" And so we all have that, I think, in our core is that when our life is over, when it's over, will the world be a better place because we were there? So a passage I like to use to reflect this is the last 2 verses of Acts 4. If you look at Acts 2, 3, and 4, you've got the unfolding of the first century church. God is revealing himself in a fresh new way. And people are being healed, the blind see, the lame walk, and so on. And we're introduced in the last 2 verses to Barnabas, of later on in Acts, Paul and Barnabas acclaim. It says, Joseph, a Levite from Cyprus, whom the apostles called Barnabas, which means son of encouragement, get this, sold a field he owned and brought the money and put it at the apostles' feet. Now, I think what's important to notice is what Barnabas doesn't do. He doesn't take the first fruits. He doesn't say, we've had a great harvest this year. I'm not going to give 10%. I'm going to give 20% or 50%. He doesn't do that. He takes this illiquid piece of dirt and he sells it and converts it into a gift for the ministry that's going on in his community. Yeah, I think that's driven by him wanting to be engaged in the miraculous things that God's doing. So as we look at these different strategies, I want to emphasize this is not primarily about clever tax strategies. This is primarily about giving your friends of Christian heritage an opportunity to use the resources, whether modest or massive, large, using those in a way that is efficient from a tax perspective, but more importantly, helps them have the impact on their family, on their community, on the country, perhaps on the world that they might not otherwise have. So it's the heart of the issue. And although we're going to look at some neat strategies, that's really not the driver. It's the spiritual component that I want to focus on. Let's start with the very basic here. I was with a fella in North Dakota a few months ago, and at the end of our conversation, he said, I've never thought about it before that all the giving I've done over the last 30 years, all of my giving has been out of after-tax dollars. That's the way most of us give. The $420 billion given in America last year, about 70% of it given by individuals. Most of that money is people writing a check. That's what we do when we go to church. That's what we do many times with charity. You get invited to a banquet or something and you write a check. When you do that, you're giving out of your checking account money that's already been taxed in order to get into your checking account. But many times there's things that you can do with pre-tax dollars. So let's look at a very simple example. Let's say you bought some stock years ago for $10,000 and recognizing that today the combined long-term capital gain rate is 23.8%, not counting your state if you have a state long-term capital gain tax. So let's say that $10,000 today is now worth $100,000. What often happens is someone will, they'll take that stock, they'll sell it, and then they'll make a gift to charity. Now, sometimes they'll sell the stock and they'll make a $100,000 gift, but they don't have $100,000 anymore because they have to pay this long-term capital gain tax of $21,000. So really all they have is $78,000 after they've paid the tax, which means they have to dip into another pocket to come up with the full $100,000. It'd be much easier, much more efficient, if they would simply give the stock, give the General Motors or Apple or Google or whatever they own stock directly to Christian Heritage, and now let Christian Heritage sell the stock. And under the system that we enjoy, the most generous system in the world, by the way, in terms of encouraging charitable giving, now then the charity can sell the stock tax-free, and the amount that's free and available to go to the charity is $100,000, and the deduction is $100,000. Versus if they give the after-tax proceeds, their deduction is only $78,000. So this makes a better scenario for the ministry, for the charity, and a better deduction for the donor. Well, that's very basic. Probably many of you, maybe all of you, are aware of this, and then maybe that's how you do some of your giving. Whether you do it directly to the charity or you use a donor-advised fund, this would be very basic, but the principle follows through as we move along. Here's a couple. This is a real couple in the Midwest. This is not their real name, but they're farmers. They bought this farm that they call Foxhaven 40-some years ago. They paid $150,000 for a farm that today is worth $3.6 million. It's not thousands of acres, but it is close to the city that it's closest to has grown out over the last 40 years, and that's really raised the per acre value. They have two other farms that have been in the family multi-generations, and so they want to keep those farms in the family. They also have a home and they have some investment. That all adds up to about $4 million. This couple are in their mid-80s. They have two children in their 40s, and they felt together as a couple, as we talked about this, that if they gave their children $2 million each, tax-free, that would be enough. Now, many people would say that. When I first got into this work, I used to carry adoption papers with me wherever I went. But the point here is that every family is different. And for this particular couple, they felt that if they gave their children $2 million, that would be plenty. The husband, in fact, said, that's a lot more than we had when we got started. Their real felt need, if we go back to those three needs I talked about, their felt need was the taxes they would face if they sold Foxhaven, because their CPA told them they'd pay more than $800,000 in long-term capital gain taxes. Well, the wife in particular was quite animated about the idea of writing a check to those boys in Washington, is kind of what she said, for $800,000. She just was not going to do that. So they felt stuck. He's 84 years old. He's off the tractor. So they've been renting the farm out. Their rental income on a $3.6 million asset was running about $18,000 a year. So if you do the math, that's about a half of 1% return on a $3.6 million asset. So they were a little frustrated. They wanted to enhance their retirement income and provide for their children, but not pay the taxes. So what we did is we took 5/6 of the farm and we transferred it into a trust called a charitable remainder trust. This is a tool that Congress set up in 1969. It was formalized, rather, in the 1969 Tax Act. It's a tax-exempt trust because the remainder at the end of Jack and Betty's life is going to go to charity. During their lifetime, it's considered a split interest trust because it has two beneficiaries. The lifetime beneficiary is Jack and Betty. The remainder beneficiary is charity. So we put 5/6 of the farm into the trust. That 5/6 is sold to the buyer, and the buyer writes a check not to Jack and Betty, but rather to this tax-exempt trust, check for $3 million. Well, the benefits to Jack and Betty are, number one, they pay no long-term capital gain tax. So we've eliminated that $800,000 tax bill. Number two, they have income coming for the rest of their lives. The income can be a set dollar amount for some families. It could be a set percentage. So that's a little bit more detail than we want to get into right now. But there's different ways we can structure it based on the age and the desires of the donor, of the benefactor. For them, they wanted to take out 5% or $150,000 for the rest of their life. So the trustee now will manage that money. Sometimes some of our larger Christian university clients, they'll manage that money themselves. Other times, Jack and Betty would bring in their own investment person to manage the money. So there's different ways that can be structured too. But the trustee will oversee that and write checks every quarter to Jack and Betty for an annual total of $150,000. So they've gone from $18,000 to $150,000. Now that leaves us with 1/6 over here that they transferred as a current gift. So 1/6 goes in to a donor advised fund, and that is sold to the buyer. Now the buyer writes a check for $600,000 back to charity. In some cases, the gift, we had a warehouse thing in California where the charity itself received an undivided interest in the piece of real estate. In other cases, like Jack and Betty, they had multiple charities that they wanted to give to. So we used a tool called a donor advised fund, which you may or may not be aware of. I'll give you a quick overview. It is another tax exempt entity. There's no income in this case coming back to Jack and Betty. It's all going to go to charity. These have been around since the 1980s. The largest one out there is run by Fidelity. There's several Christian faith-based donor advised funds out there. The largest of those is National Christian Foundation. The one my wife and I have had our donor advised fund with for 20 years is called Waterstone. And there's some others as well. But it does provide you an environment to place an appreciated asset in, sell it tax-free, and now you have money in there. My wife and I call it our charitable checking account. So all of our giving comes out of our donor advised fund, and it can go to multiple charities. All of our monthly giving goes through our donor advised fund, as well as when we put an appreciated asset gift in there, it goes through our donor advised fund. Three quick things. I'll just drill down a little bit deeper. Three quick points. Whoever you use for your donor advised fund. Number one, it makes my tax filing easier. 20 years ago, I used to have to wait for all the different charities that we gave to get around to sending me their receipts for my taxes in the first quarter of the new year. Now I get one receipt with an itemization of all the charities that we gave to. So it makes my tax filing easier. Number two, we get invited to banquets sometimes by friends of ours, and they love some particular ministry, and so we go, and I don't want to go and just be a freeloader. So I'll call my donor advised fund up and I'll say, could you cut a check for $500 or whatever to XYZ charity, but I want to be anonymous. So now I can make a gift to the organization at the banquet, but I'm not now on their mailing list. I don't have people calling me because we're pretty locked in on the ministries that my wife and I give to. And so if I have more money, I really want to give more money to those organizations. There's exceptions from time to time. The third benefit is in our estate plan. In our estate plan, 1/4 of our estate is going to ministry, but it's all going through our donor advised fund, so that if 10 years from now we change our mind on some organization, we don't have to have a codicil done to our will. We can simply call the donor advised fund up and say, take this ministry out and replace them with this organization. So those are 3 reasons that I'm a big fan. Whoever you decide to use, I'm a big fan of people using donor advised funds because I think they provide a lot of stewardship benefit. All right, so that's Jack and Betty. The summary here is the largest previous gift of their lifetime before this was $15,000. Now, these farmers, they're making a gift of $600,000. This is a wonderful balance sheet, but like many farmers, their cash flow isn't necessarily that great. So they went from a $15,000 gift to a $600,000 gift by simply doing some planning with them. Their income went from $18,000 to $150,000, and we eliminated $800,000 of taxes. So there'd be a great example of dealing with a field too, like Barnabas, but in the 21st century model. I'll do one more and then we'll begin to wrap up. This is a couple we worked with actually up in the Northwest last December, and they have several little businesses. This particular one's worth about $10 million. They have several children, and their 2 sons have been running this business now for about 5 years. Mom and dad have been transferring more and more responsibility over to the boys, keeping control of the company. The boys have been on salary and they get bonuses and so on, but they have no equity, no stock. Last year, the husband and I talked several times, and he felt like he was ready to begin moving ownership down to the boys. But he didn't want to sell them the stock and pay taxes, nor did he want to give them stock and have them feel entitled. He wanted them to feel like they'd earned that ownership. And so what we did in December is we moved $4 million, 40% of non-voting stock, down again into a donor advised fund. And then the boys, that was in December. In February, the boys bought the stock out of the donor advised fund on a 15-year note. So they now have 40% ownership. They have quarterly distributions coming out of their ownership of the business. They're using those new quarterly distributions to make the note payments back to the donor advised fund. So Mom and Dad's primary goal here was to give the sons a sense of ownership so they don't feel like employees. They want to keep growing the business. If they continue to grow the business at 10 or 15% a year, by the time this $4 million note's paid off, that their stock could be worth, who knows, $8 or $10 million. And that's exactly what Mom and Dad wanted to do, is to give them, though, that sense of ownership and incentive. But in the meantime, by running the stock through the donor advised fund, they were able to pay 0 long-term capital gain tax and also create a deduction of $4 million. And so as the note is paid off, there's money building up in here, and Mom and Dad now have $4 million to give out to the different ministries they care about. This particular couple is extremely generous, and they have put 450 children in developing countries all the way through college. And so extremely generous couple, but they're also very smart in how they do their giving. And what it allows them to do is not spend money unnecessarily on taxes, but rather harness and capture those dollars for eternal impact on the organizations they care about. All right, so wrapping up here, that's me at the top and my business partner, Richard Blackman. And this is my 40th year doing this work, and we would love to just be helpful to you. If you have a question about a closely held stock or a family business or a piece of land, there are certain things you have to be careful about as you're doing this. You can't put debt encumbered property into a charitable remainder trust. You can't put S Corp stock in a CRT. So there's certain things that you have to navigate. But our work is paid for by the charities we serve. So we don't sell insurance. We don't manage money. Our work is a gift brought to you as a donor, as a benefactor, to help you be more strategic in what you do. And by the way, the money doesn't all have to go to one charity. We want to respect your wishes on who you care about and who you give to. So we're really here to serve you, redeploy dollars that might have otherwise been lost unnecessarily, and use those to have the kind of impact that you'd like to have. Love to talk with you if that would be helpful. Bye.